In this video, we're going to be performing a deep dive on Ecolab's dividend safety. To begin, let's talk about Ecolab's business model. Ecolab is the global leader in water, hygiene, and energy technologies and services. The company operates in three major business segments: global industrial, global institutional, and global energy, each of roughly equal size. Ecolab was founded in 1923 and has grown to a market capitalization of $43 billion and annual revenues of almost $15 billion. Ecolab is a well-known dividend stock because of its compelling track record of dividend growth. With 32 years of consecutive dividend increases, Ecolab is a member of the Dividend Aristocrats Index, a group of elite dividend stocks with more than 25 years of consecutive dividend increases. Looking ahead, investors cannot rely on Ecolab's dividend history alone to measure its dividend safety. For the remainder of this video, we will discuss the company's current dividend safety from four perspectives: its dividend safety in the context of its current earnings, its dividend safety in the context of its current free cash flow, its dividend safety in the context of its recession performance, and its dividend safety in the context of its current debt load. First, let's discuss Ecolab's dividend safety in the context of the company's current earnings. When Ecolab reported third quarter financial results on October 30th, the company reported that it generated adjusted earnings per share of $1.53 in the 3-month reporting period. For context, Ecolab paid a 41-cent dividend during the same time period for a payout ratio of 27%. Looking out over a longer time horizon, our conclusion is the same. Ecolab generated $3.53 of earnings per share through the first 9 months of fiscal 2018 and paid $1.23 of common share dividends during the same time period for a payout ratio of 35%. Using earnings, Ecolab's dividend appears very safe for the foreseeable future. Many analysts believe that comparing a company's dividend payments to its free cash flow is a better method for assessing dividend safety. With that in mind, we will now compare Ecolab's current dividend payment to its free cash flow. Through the first 9 months of fiscal 2018, Ecolab generated $1.45 billion of cash from operating activities and spent $634 million on capital expenditures for free cash flow of $816 million. The company distributed $370 million of common share dividends during the same time period for a free cash flow payout ratio of 45%. Using free cash flow, our conclusion is the same as when we use earnings to measure Ecolab's dividend safety. The company's dividend appears safe for the foreseeable future. Companies do not cut their dividends in the good times. Instead, dividends are reduced when companies experience financial difficulties. With that in mind, this section will analyze Ecolab's current dividend safety in the context of the company's historical recession performance. We believe that the best way to measure a company's recession resiliency is by assessing its earnings per share performance during the financial crisis that occurred between 2007 and 2009. Ecolab's performance during this time period is shown here. As you can see, Ecolab's earnings per share continued their streak of uninterrupted increases during the 2007 to 2009 recession. With that in mind, we have no concerns about the company's ability to pay rising dividends during future economic downturns. The last angle that we will use to assess Ecolab's current dividend safety is by looking at the company's current debt level. More specifically, we will see how much the company's weighted average interest rate will need to increase before the company's free cash flow will no longer cover its dividend payment. Through the first 9 months of fiscal 2018, Ecolab generated $179.5 million of interest expense and had $7.1 billion of debt outstanding for a weighted average interest rate of 3.4%. The following image shows how changes to Ecolab's weighted average interest rate would impact the company's dividend safety as measured by free cash flow. As the image shows, Ecolab's weighted average interest rate would need to rise to approximately the 12% level before its dividend would no longer be covered by free cash flow. With that in mind, we believe that the company's debt level is unlikely to impact the safety of its dividend moving forward. Thank you for watching today's video, which performed a deep dive on Ecolab's current dividend safety. We invite you to subscribe to this channel and like this video, which will help more people discover ShareDividend's investor education efforts. If you are interested in learning more about our systematic approach to dividend growth investing, visit our website at www.sharedividend.com.